The next type of question we're going to do is a replacement decision. And essentially, this is actually just a net present value question. The only difference is there's a bit more involved. You're changing one machine for the other. So you're going to need to calculate the change in cash flows. And that's going to be the incremental cash flows. So let's look at one of the examples. It says that we're looking at replacing a machine. So the cost of the new machine is going to be, to replace the existing machine, it's going to be $350,000. The market value of the existing machine is $50,000. So really, the net cost of this machine is going to be $300,000. So it's like when you buy a car. Okay, if you trade in an old car, you just pay the difference. So in this case, they're selling the old machine at $50,000 and buying the new one at $350,000. Salvage value of the existing machine is $15,000 in 8 years. So if you kept that, salvage value of the new machine is $100,000. If you replace the machine, you'll have annual savings of $50,000 a year for 8 years. Now, keep in mind that this doesn't say after tax, so this is going to be pre-tax savings. Tax rate's 40%, cost of capital 15%, and the CCA rate is 30%. Should the company replace the machine? So what we will do is treat it like a regular NPV question. So I'm going to write the description of the thing we're looking at. So the first description will be the change in investment, okay, which is like the cost in a normal NPV question. So this one is given. The change in investment is $300,000. It's going to cost us $350,000 to buy the machine, but we can trade in the existing one for $50,000, so it's costing us really negative $300,000. The other things that we're going to consider is a change in after-tax cash flows. So we're going to need to calculate that. The change in the present value of the CCA, because we've got a different machine with a different value, so we're going to have a different tax benefit, and then the change in salvage value. And these are all going to be in present value form. So this is going to be a PV of an annuity. This is the PV of a lump sum. And this is the PV of the CCA formula. So that big formula that we used before. So let's do the first one. Let's do the salvage value. Always start with the easiest. Salvage value is the present value of the salvage is going to be, first of all, what's the change in salvage value? The change in salvage value is if we buy the machine, the new machine, that's our default, we will get $100,000 in salvage value. However, that means we won't get the $15,000 that we had for the existing machine. So just like we adjusted the cost, we will adjust the salvage value by $15,000 and divide it by 1 plus the discount rate, 1.15, to the number of years, which is 8. So we get a total value of $27,787. Okay, so the present value of the change in salvage is going to be positive $27,787. The next one is the after-tax cash flows. So this is just a straightforward ordinary annuity. This one they've given us, it's going to be the amount times, and by amount, I'm going to say after tax, times the annuity formula, 1 minus 1 over 1 plus r to the n over r. So the after-tax amount is going to be 15,000 times 1 minus the tax rate of 0.40. So this gives us the after-tax savings, and R is 0.15 for 8 years divided by 0.15. So we get after-tax savings of 134,620. So let's put that in here. Positive 134,620. Now the last one is a CCA formula. So this is it's a big formula, but it's not really complicated. We just need to plug it in. So let's go through it. So the present value of the CCA is going to be, I'll break it into two parts, the left part and the right part. So the change in cost times tax rate times D, which is a CCA rate, over D plus K, times 1 plus, and I'm going to use 1.5 because that's the current rate, but as I mentioned in my previous video, you could end up using 0.5 or 1 depending on what the rates are. Okay, divided by 1 plus K. Okay, and all of that we will minus the change in salvage times tax times depreciation rate over D plus K times 1 over 1 plus K to the power of 8. Okay, so we have all of these numbers. The change in cost was 300,000. Tax rate is 0.4, CCA rate is 0.3, and K is 0.15. And then change in salvage we calculated as 85,000. So the 100,000 minus minus the 15,000. Okay, so if I won't plug it all in and do everything. It's very simple to just plug it and do the calculation. The answer will be 77,808. So you will have an extra tax benefit of 77,808, which makes sense because you're spending more money on the machine, so you would expect your tax savings to go up. So if I add all of these up, I will get a net present value of negative 59,785. Therefore, do not replace the machine. Okay, so you can see it was just a regular NPV question. It was just a bit more involved because we had to do the change in cash flows this time.